In this video, we're going to go through sales transactions involving two separate performance obligations. One, the delivery of goods, and two, extending credit to our customer. We're told that on January 2, 2020, Stellar Inc. sells goods to the Geo Company in exchange for a zero interest-bearing note with a face value of $11,100, with payments due in 12 months. The fair value of the goods at the date of the sale is $10,200 with a cost of $6,120. So we have a contract with a customer, the Geo Company, and we can identify two separate performance obligations. One, the delivery of goods, and two, the extension of credit. We can easily determine the transaction price, which is $11,100, the face value of the non-interest-bearing note, and we have to allocate the transaction price between our two separate performance obligations. We do this because we're told the fair value of the goods that we've exchanged at the date of sale is at $10,200, which means the difference of $900 will be allocated to the interest portion of our performance obligations. So on January 2, 2020, we will record the notes receivable of $11,100, and we will report sales revenue of $10,200. And again, that's the portion of the transaction price we've allocated to the delivery of goods. And then the difference, of course, will be simply a plug to a discount on notes receivable of $900. Also on January 2nd, we need to match our costs with our revenues. So we record an expense, cost of goods sold, equal to $6,120. And of course, we will credit inventory for the same $6,120. On December 31st, when we receive payment, on January 2nd, when we receive payment for the note, we'll record cash and take the notes off our books. On December 31st, we need to record interest revenue for the 12-month period from January 2nd to December 31st. We will want to record $900 in interest revenue, perhaps a little bit less if we want to get picky about the actual 365 days, but it's certainly close enough to $900 in interest revenue. And of course, we will debit the discount on notes receivable for $900. Then when we receive payment on January 2nd, 2021, we will of course debit cash for the $11,100, and we will remove the note from our books. The total revenue that we recognize in 2020 will be $11,100. That's the $10,200 in sales revenue and the $900 in interest revenue. So once again, we had two separate performance obligations. One, the delivery of goods, and two, the extension of credit. Let's take a look at another example. In this transaction, we have essentially the same thing going on, except now we no longer know the fair market value of the merchandise that we've transferred to the Geo Company. Instead, we know the market interest rate on this type of note is 8%. So let's go ahead and record our transaction and identify our performance obligations and the satisfaction of those performance obligations. So again, step one, we do have a contract with a customer. We have the two separate performance obligations, the delivery of goods and the extension of credit. We have a total transaction price of $20,000, the face value of the note, and we will need to allocate that between the delivery of the goods and the interest component. And we'll recognize revenue when each of those performance obligations is satisfied. So we begin by recording the face value of our note, as always. So notes receivable for $20,000. And we're going to need to calculate the present value or fair value of the goods that we delivered to the Geo Company. We do this with our present value calculations. We have a market interest rate on the note of 8%, a one-year period. We're making no payments on the note. It's a zero interest-bearing note. And it has a face value or future value of $20,000. So we find our revenue portion related to the delivery of the goods is $18,519. So when we satisfy that performance obligation by delivering the goods, we will record $18,000 in revenue. And of course, the difference will be credited to a discount on notes receivable. On January 2nd also, we need to record the cost of goods sold component of our sale, as well as reducing our inventory by the $14,500. On December 31st, we will have satisfied or almost satisfied our second performance obligation, which is the extension of credit to our customers. And we're going to want to record interest revenue of $1,481. And again, that's simply the difference between the fair value of the goods that we delivered and the face value of the note. And we debit the discount on notes receivable. Then on January 2nd, 2021, when we actually receive the cash payment, we'll debit cash for $20,000 and credit our notes receivable. The total revenue that we would have recognized in 2020 is once again the sales price of the merchandise of $18,519 plus the interest that we've earned of $1,481, which in total equals the face value of our note.